Well, good afternoon, investors, and welcome to the bull session, which happens to be on the second least amount of daylight in the calendar year. Tomorrow is the solstice, so this is the solstice eve, and it's a couple days before Festivus and a few more days before Christmas. So we thought we'd spend a few minutes together, and we are going to have a show a couple days after Christmas. But we do look forward to that. So welcome, everybody. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and basically a long-term investor following the principles of the Modern Investment Club movement. More on that in a minute. Since the early 1990s. Joined here by my dear colleague, Ken Kavula, who we generally regard as a raconteur. And not only that, he is our Lionel Messi of the investing world.
I just had the door open and my granddaughter is standing here. We're babysitting today. She's 4 years old, and she wants to know who I'm talking to. So
and I'll bet you she knows that's a
Mark, and you have to go now. Okay, bye-bye.
And she's like, Grandpa, did he just say you're messy? All right. And we're also joined by Kevin Gillogly again this afternoon. Good afternoon, Kevin.
Good afternoon, all. And I want to let you know I'm sitting here waiting to grab a flight to be able to find some of that nice, cold, snowy weather. I'm in Baltimore, ready to go to Chicago. And here in Baltimore, we're part of the Ken Kavula fan club. I am one of the chapter presidents of the Ken Kavula Baltimore chapter, and we're glad to be here.
Well,
so is Chicago your end destination, Kevin?
Destination is Chicago, outside of Chicago, yeah. And I live here in Baltimore.
Okay,
that is the place of the Gillogly family these days. So,
well, that storm is supposed to come right across the top of Chicago and then right into the middle of Michigan. So we'll see if you get to experience any of it. Some really, really cold weather coming with it, evidently.
I've got my big snow boots on and a big heavy duty parka on the flight, so I'm ready.
All right. I think what we will do is skip ahead to the Kevin part of the program just in case he gets called for boarding here shortly. But we are going to talk a little bit about an investment club in Michigan sent us a question about why the analysis looks like a camel. So I dubbed it dromedary analysis. We'll take a look at that. We will briefly spend a moment with some magazine covers and hope that we're not so far from a magazine cover basically declaring it the end of the world for investing so that we can all go out and go shopping. Should be some good stuff. And then we'll spend some more time counting down a few more selections for this year's Christmas countdown. Anything else you'd like to add to that, guys, or should we press on?
Let's press on, Mark, okay?
Okay. All right, standard disclaimer, we do have a few new names in the audience. Welcome back to everybody who's been here before. Welcome if you're here for the first time. We do try to keep this fairly informal. It is about a demonstration. We're illustrating the methods, techniques, philosophies, beliefs, basically all that stuff with respect to the discovery of investing opportunities, most often in stocks, and the design of a portfolio and the management of said portfolio following the techniques and history of the Modern Investment Club movement. That's what we try to do here and demonstrate here. No investment recommendation whatsoever is intended. We will talk about some companies in real time. Please do your own homework. We'll try to remember to disclose if we actually hold companies in personal portfolios, and we are 1 week away from our monthly webcast, the Roundtable, where we specifically share 3, 4, or 5 ideas and basically just share how they're discovered and how they are analyzed using the techniques of the Modern Investment Club movement. If you'd like to be added to a reminder list for that, because we do get several hundred attendees now, please send an email to nkavula1@comcast.net. If you have any follow-up questions, suggestions for future topics, or if you want to basically call out a moment that we're going to talk about before we sign off today, do you have a moment from the last year kind of a favorite moment that we might cover in next Tuesday's session. We'd love to hear from you. If you'd like copies of the slides, that's also the case. Please send an email to markr@manifestinvesting.com or kcavula1@comcast.net. All right. Here's basically the agenda. We are going to continue the Christmas countdown. We'll probably finish it off in the forum here in the next couple of days. But we do want to talk briefly about magazine cover market inversions. That's basically just noticing some moments in time that have been kind of special and led to unusual things. Then we do want to answer the question from the Washtenaw Investment Club near Ann Arbor, Michigan, that wants to talk about car gurus. We'll update the Groundhog Challenge, and then we also want to talk about where the Rule of 5 meets Barron's Best. Barron's actually has a pretty outstanding track record when they name their stocks for the next year, so we thought we would check in with that. And I'm going to actually jump right to that. You guys don't mind in case we lose Kevin at some point. And hopefully you're okay with that, Kevin.
Yeah, that's fine.
Because they might be.
I got about 25 minutes before they start lining this up.
All right. Well, Kevin actually reached out and wanted to talk about the notion of identifying some companies and ideas that maybe you're destined for weaker performance. And I explained, and I think we've talked about this here before, Ken. George Nicholson at Better Investing did that one time in the history of Better Investing magazine where the stock to study was actually intended to be a bad idea. This goes all the way back to the 1950s or early 1960s, and he never did it again. And the reason was people went out and bought it, even though he was trying to call out, here's the lowest quality, most overvalued stock I can find back in 1961 or whenever it was. But I guess people have been challenged by reading instructions and details for many decades, Ken.
Well, Mark, you know that one of my greatest fears always is mentioning a name and then having somebody call me on the phone the next day or 2 days later telling me that they dropped $500,000 into that name or something along those lines. So I always cringe when people tell me they immediately bought something that I mentioned. I'm talking about studying stocks, folks. Make your own decisions and don't make them based on the fact that I like something or that Mark likes something or that, heaven help us that Kevin likes something. So.
No, not that.
All right.
Right. So we're actually going to engage in a workaround inspired by Kevin, where we're going to take a look at Barron's top 10 selections for the coming year. And we're going to try to pick out the least well-behaved according to the Rule of 5. In other words, we're going to try to identify the two that are most likely to perform the weakest. So that's where we're going to go. But thought we'd spend just a moment with this feature. It is in the current issue of Barron's magazine right now, and it's kind of interesting. Here's basically what they did a year ago. And these were the 10 selections made mid-December 1 year ago. And it's a pretty formidable list. And true to the Rule of 5, which is basically just a probability distribution of results. In other words, if you pick 10 companies, we believe that 2 of them will significantly underperform. 2 of them will probably exceed expectations. And then in the middle, you have these 6 that basically are going to come within, a reasonable distance of, a market average or something like that. And this distribution actually shows up here fairly well. You can see that the worst performing stock was Amazon, down 46% from last December, followed by General Motors at minus 30. And then, I don't know about you guys, but I have to admit, I'm kind of stunned that Amazon is the worst of the list. And Len Douglas, of course, is not surprised that Shell is the best of the list, because he's been talking energy stocks for some time. But what are your thoughts as you look at this, guys?
Well, there's no model is perfect, and that's about as nice a fit to the Rule of 5 as I've seen in any other group of stocks that people have been playing around with. I do like the fact that Barron's actually outperformed the market. I think that's admirable in the kind of market that we've had. It's pretty easy to do it in 2021, but to do it in 2022, I think really says something. And to do it with an oil company at the top of the list and an old tech company following it in second place, I think tells the rest of us to not disregard complete large sectors of the market just because they don't usually behave the way we think they should behave.
Absolutely. And Kevin, I thought you might enjoy that Heisman groundhog on the lower right there.
Absolutely. Although none of my teams have had a Heisman in a few decades, but I digress.
Well, the interesting thing here is that these 10 stocks, if they were in our groundhog challenge, would be in second place right there with Herb Lemkool. So
Maybe we ought to just Herb pick the winners.
Well, Herb, yeah, we should just let Herb pick the next list, I guess. So anyhow, that's what the golden Oscar is for on the upper right, worst performing stock, and that's what we're basically pursuing for this year, trying to predict which of the 10. Now, again, Barron's is holding these out as 10 good ideas, and we're basically just saying which ones might be the more likely to be the weaker of the ideas. Here are the 10. Alcoa, which again would not show up on many of our lists because of the nature of their business and the cyclicality, but Google and Amazon are on many of our purchase lists these days. Bank of America, we tend to favor smaller banks, but it's there. Berkshire Hathaway turned in a real solid performance. They would be in the top 5 of companies for the last year, and that's a repeat selection for this year. And here's one that kind of stunned me, Comcast. Maybe I'm just biased by the number of times I've had to call them and work through customer service situations, and I'm really sugarcoating. And Delta, interesting selection. I wonder if their book value includes all of my lost luggage. I shouldn't mention that with Kevin sitting in the airport, should I?
Of course, folks, I've had to go to different airports to pick Mark up when we have speaking engagements because he won't fly Delta. So I've flown into a city where Delta drops me, got myself a car, and then driven to another airport in that same city to pick up Mark because he's flying Southwest. So he really does follow what he believes. So.
Well, that's good to hear that it's Southwest, Mark, because I'm in the Southwest gate right now.
Yeah, that's a pretty good flight from there, and they're very unlikely to lose your luggage, Kevin.
Well, not only that, but they now, instead of going into Midway, they now go into O'Hare, into the international terminal. So that's perfect for me on the north suburbs.
Definitely closer to home for you, yeah. Good stuff.
Oh, yeah, when I go into Midway and I tell them I'm going to Lake County, they think Indiana. It's like, no, this is Lake County, Illinois.
Yep. All right,
so
the final 3 there, Madison Square Garden Sports, which I had not looked at. I did add it to coverage at Manifest Investing. And, of course, we know Medtronic very well in the community and Toll Brothers in our infatuation with the housing stocks long term. So that's a pretty good list. So let's take a look at it through our prism, and I thought we would go ahead and make some selections here. Let me go ahead and get out of this for just a minute. Try not to lose too much of the screen here. All right, so Kevin, of the 10 selections made by Barron's, which one do you feel might be a candidate for bringing in the weakest results?
Delta.
You're going to go Delta?
Absolutely.
Okay, right out of the box.
If you look at that quality ranking, I mean, I think, airlines are designed for, they're primed for a turnaround, but like you, I haven't looked at Delta in depth, but I just don't see the whole airline industry coming back completely at the moment. So that's the reason I think Delta's it.
Okay. And Ken, what about your first choice?
Well, and I'll tell you, there's been no collusion, no discussion of this prior to this moment, but I'm also choosing Delta as the worst performer in the group.
Okay. Makes for an interesting situation. I mean, I have invested in things like Southwest from time to time, never Delta, but Southwest from time to time, but never as a long-term holding either. And it's actually worked out pretty well. Hugh and I both chased Southwest for the roundtable not too long ago. Well, my first choice is just simply the Madison Square Garden sports. If you read through the Barron's analysis, he basically talks about the ownership of the facility and the teams, and tries to make a case that they're worth 10 times more than that based on the average value of whatever. And I just don't see it. You know, you look at a projected return on value close to 3%, and plus it's affiliated with the Knicks, so I have to, kind of hold my nose and vote against them. So I'm going to start with them. How about your second choice, Kevin?
I'm going to go with Madison Square Garden.
Okay.
I think, like you said, it's just, I mean, I just don't think that people are going to be going out doing a lot of entertainment, like they did, prior to the pandemic. Just anecdotally, just going to movies with my friend Ken Williams. We're like almost one of only 3 or 4 people in the theater. It's just not full like it has. And now, granted, it's a movie theater, and here we are talking about entertainment. But I just think overall people aren't going to as many entertainment operations as well. So that's the reason I have them as my second choice.
Okay. Ken, what do you see as the second weakest performer?
Boy, I'm going to go with Alcoa, Mark.
Okay. Any particular reason? Just you don't like
I don't like the difference between the prove and the par values. I really think that the par value is inflated, even though it's the highest one on the list. It's the prove value is 33% lower than the par value. I'm looking at a negative sales trend, 22 to 23. If I'm reading that last column correctly, am I reading that correctly, Mark?
You're looking at a downdraft. And by the way, I mean that screams potential recession when you look at that from top to bottom.
Yeah. So I think I have enough reasons to support the thing, although I do know that metals and mining can be really move quickly in one direction or the other. So there's always the possibility at the end of the year next year this one will be probably in the stratosphere because I chose it. So
all right.
What are you picking for your second worst,
My
Mark?
second one, I mean, I'm tempted just from the moments of frustration with Comcast to put them on the list just out of spite. But I'm going to actually pick a slightly different one. I'm going to go with Toll Brothers. And that's not because I don't believe in the long-term virtues of housing. They happen to lose their co-founding CEO, passed away in October. And their environment is challenging enough without that, and I just think they could be in for some fairly serious challenges and a little bit of upheaval in the corner office. So I just kind of hold that out there as a kind of a warning. All right, Kevin, your third selection.
I'm going to follow you with Toll Brothers. I think, again, long term, it's in really, really good shape. But I just think the way this market is, if it has any kind of pop, I think it's probably going to be in the second half of the year. I just think that the way things are going, that it's going to slow down. Even though there's a big demand for new housing, I'm going to say I don't think it's there yet.
Okay, and Ken.
Well, I think the Fed has overshot with interest. I think that the housing market is not going to recover as quickly as some people expect it to. I think maybe 24 is the year when you when you look to see the housing market recover, which means I'd maybe be buying Horton or Toll or Lennar or something like that near the end of 23. But during 23, I'm going to pick Toll as the third worst performer as well.
I have to say, I did not expect that all three of us would single them out. Interesting. All right. And for my last one, I just simply can't let an opportunity to throw a brick at Delta Airlines go by the wayside. So that's my third pick. And we'd like to hear from all of you. If you want to participate and basically say how would you fill out this chart for yourself, send them in to me via email, my email address at the bottom, or post it in the forum, and we'll actually do a coaches poll and come up with something that we can look back at next December. So good stuff, and
we've probably guaranteed these 3 or 4 stocks here in this chart now to outperform everything, Mark. So just by choosing them, so
I'm sure
keep that in mind, folks. Okay.
Yeah, Nick DiVirgilio is probably out there buying Delta and Madison Square Garden as we speak.
Okay.
Mark, here's what I'd say to your audience is that since we start Festivus in 2 days, is that we can have the 8 days of Festivus, just like of Hanukkah. So from the 23rd to the 31st, get your 3 ideas from these 10 and submit them. And we'll see who's doing the worst.
And the airing of grievances are welcome here?
Yes, airing of grievances is perfect for Festivus and for this list of stocks that we think are going to create a...
I'll tell you, the two of you need to get a life, okay? How many times have you watched that what is it? A single Seinfeld session or lots of them? Just a single episode or
Yes.
I'm not sure if it's multiple episodes or not.
No, it's just one episode.
I must admit that Seinfeld was never one of my favorite television programs. So,
well,
let's continue here, Mark.
I will guarantee you that Kevin and I will be watching that episode, and we'll watch it with you in mind, Kevin.
Thank you.
And I think I'm even watching on the plane out, just so I can enjoy it.
All right,
there's a cameo of Jack Black in that one.
All right. Well, travel safely, Kevin. Hang in there and feel free to chime in, but I do realize that you're probably going to get pulled away to the gate in the next 10 minutes or so.
Yeah, I'll just mute myself so I can still listen, but happy holidays to everyone and enjoy.
Merry Christmas.
You
sir.
As well, Kevin. You as well.
All right. Just checking in on Jerome. I did mean to have Kevin swear in and swear that he's not on Jerome's staff in any way, like we did with Christy last week. But again, very little change. We actually, you will recall that we had touched the blue line as we wrap up here the end of the year. We will be forming a new green bar for the first quarter of 2023 here in approximately a week. But we didn't stay at the blue line, Ken.
Well, and I think, Mark, what kind of surprises me is how close to the 20-year or almost 25-year average the value line medium appreciation potential is at the moment. Looks like it's just over 12, and the long-term average is 11.6. It feels like the market is really undervalued, but I think this is telling us that the market is pretty fairly valued, in fact.
Yeah, in fact, that's one of the reasons I want to listen in on you mentioned Josh Brown making some comments along these lines. And I do think the market is probably more fairly valued than many people realize. And it does have some room for some continued, we've been calling it an accumulation opportunity. That might persist for a while. All right. I just threw this one in there because I look at this stuff all the time, and it just had escaped me that housing was such a large influence on the CPI. It's one of those things. I knew it after I saw it again, and I think it's just a very powerful reminder. And that's all the more reason. Again, I want to listen to Josh, but when that started going crazy, you had to expect it in the CPI at some point. Were you aware that it was as much as it is?
I did not know that it was over 40%. But the point that I've made a couple different times in a couple different venues is that folks that own their own home, or folks that are in the middle of a fixed rate 30-year mortgage, maybe haven't experienced inflation to the degree that the numbers that are flashed up every month suggest that inflation is taking hold in the country. Now, if you're out there looking for a new apartment, or if you're out there trying to buy a new house, and of course, the full impact of inflation is slamming you. But there's a whole lot of the population, I think, that sit in housing that's either the rent's controlled by a lease for a couple years, or it's a 30-year mortgage, or the mortgage is paid off and they're sitting in a home they completely own. And that, to me, I think, if I'm doing the right set of reasoning, I think that indicates that maybe the full impact of these inflationary numbers aren't at the 7, 8, 9, 10 level, but maybe they're closer to the 4, 5, 6 level, which is still a big increase from what we were used to for the last 10 or 12 years. But I just don't think, for those folks at least, it's as serious a problem as maybe the 24-hour-a-day news cycle would like to have us all believe it is. Does that make any sense to you, Mark?
It does, and in fact, boy, I don't want this to sound the wrong way, kind of snobbish, but I just want to make a point that I remember sitting in one of the National Association of Investors conferences with 400 or 500 people, and the speaker on the stage for the keynote basically asked how many people still have a mortgage. And again, 500 people sitting there. I think maybe 12 hands went up, and mine was one of them. The impact on those other 490 people is very different than what you just mentioned, Ken. I mean, if the value of your housing is going up, it feels completely differently. I mean, obviously the trips to the grocery store and gas station are still a factor, but when you flip over to that point, it really is a completely different type of inflation. And it gets quite complex in a hurry. But yeah, it's just kind of amazing when you think about the major differences. Now, the person that's renting and is challenged to pay for the fuel to get to work and all that kind of stuff, it really does affect all of us quite differently. So
it's just different for so many parts of the population. And you can understand, Mark, why transportation costs are focused on by so much of the population. I think that's one of the few costs. I mean, it's 20% almost of the whole pie there. And those are costs that you can see change on a weekly basis.
Mm-hmm.
We just celebrated in Michigan the lowest gas prices of the year. That's been all over the news now for the last day and a half. So they are moving in the right direction. At least the gas prices are. We'll have to see if everything else moves, and if some of the people are right that I'm listening to right now. Maybe the Fed has done so much that it's going to move things real quickly in a direction that's going to lead us into, to borrow a phrase from a couple different people that I've listened to, maybe we've done a really good job of talking our way right into a recession.
Yeah, and a lot of that type of stuff is going on. This graphic, kind of, on the heels of that last one, is quite compelling when you start talking about the impact of housing on the overall market. And one of the things I thought we might do is actually set aside a moment to take a look at an industry study. We just criticized Toll Brothers and talked about the challenges they'll be facing, but between Green Brick Partners and some of the other housing companies that we have a lot of faith in, long term, maybe we do a quick industry study here early in the new year and talk about what our long-term perspective looks like
Well, I want to make it clear also that I own D.H. Horton in my own personal portfolios, and I own MI Homes in my personal portfolios. That's MHO is the ticker. And I belong to clubs that still own home builders in their portfolios. And my clubs are split. Some of them have sold at a great loss their home building stocks and are looking to re-enter perhaps in 6 months or 9 months, re-enter the industry. And one of the clubs is just holding on to their home builders, feeling and in fact adding to them at this very discounted price. So I don't think there's any regularity or anything that I can draw from my experience with my own investing partners to tell me what home builders are doing right now. This is an interesting graph. I'm not sure that it would convince me one way or the other to do anything that I'm not already doing with my home building stocks.
Yeah, and the reason I think it triggered the thought of an industry study. I think an industry study of residential construction can actually be a microcosm of that topic we talked about across the chasm when all the stuff hit with COVID.
Yep.
Basically knowing that you're going to have this disruption. I think certainly this is a picture of disruptions that periodically happen in the residential construction environment. And I just think that it can serve as quite a reminder about what it looks completely different with a long-term perspective. I think that's where we would end up. Again, that microcosm type thinking. All right. Okay, let's switch gears and talk about magazine covers a little bit. This is a subject that I've just had a good time with Barry Ritholtz. The link at the bottom of the page takes you to an analysis of over 50, maybe even 100 different magazine covers. I can't read that one up at the top. It's November. I think it's November 2009, Ken. Bye Bye Bear on the Barron's cover. So that was that's only 1 year into the Great Recession. So we continued down.
We did, but not for that long a period, thank goodness, for another 3 or 4 months until I think most people would suggest that the bottom of that market was March 2010. Maybe I'm off by a month or two, but I think that's when most people would peg the bottom and then the movement upward from that point.
Yeah, and the one up on the upper left is from 2021, I think. Is inflation dead at Bloomberg? And that's about the time it started coming to life. And I do know that the Economist cover is from early last year. How high will interest rates go? That one turned out to be pretty prescient. And wish I'd have listened harder to the Economist back at that point in time.
My favorite is the bottom right, though, Mark. Okay.
Well, yeah, between Zuckerberg and the kid on the right, of course, he is now wearing orange. I believe he's still in the Bahamas.
I maybe I'll convince my wife to come on and give you her dialogue, or maybe it's a diatribe about modern children and how they were raised to never be wrong and to never do anything wrong, and how he just epitomizes that kind of child raising technique. She says he just thinks that he can apologize and everything will be okay, and he doesn't know when to keep his mouth shut. So interesting take.
The legal experts expect him to end up with at least 100 to perhaps 150 years to think about that. So time will tell. Anyhow, Ritholtz basically goes through an analysis basically saying that be careful if you see your favorite company, like, the Apple headquarters that was featured on Barron's magazine. First of all, there's a headquarters curse also. But that one has not panned out. Apple actually is up a couple 100% from the time of that cover. But I think back to Enron appearing on the cover of magazines, Micron back in the 1980s, early 1990s. When your company shows up, it can even be on a business publication as God's gift to running the corporate world, it's probably time you want to at least check your line of thinking and make sure you're not overly exposed. And Bloomberg gets the all-time prize for being the ultimate bearishness there on the upper right. 37 bears and counting. And of course, this is Ken's ultimate indicator here. Now that is not an actual cover disclaimer. I don't want to be sued by Meredith.
It's a fake. It's a fake, Mark. It's a fake. Fake news.
See, my mother raised me to admit that I put this together, and I'm not passing it off as anything else.
It does go back, however, Mark, to one of our trips to Minneapolis, speaking in front of a couple hundred investors at one of their fairs, maybe 10 years ago, maybe 10 years ago, where we were feeling really good about for-profit education, specifically Strayer and a couple of companies that I will conveniently not even mention. But we were feeling really good about them. We were talking a lot about them. We were asking people to examine them. And somebody in the audience said, I read in Better Homes and Gardens that you should stay away from these companies. And I'm thinking to myself, Better Homes and Gardens? And I got home and got a hold of the Better Homes and Gardens. And sure enough, there was a big article about for-profit colleges, and it couldn't have been more right on. The last place that I would have ever looked for information about stock investing was in Better Homes and Gardens, and there it was staring me right in the face and warning me that there couldn't be this much competition and they couldn't all survive. And the article was smack on, and I should have listened. So when I see information coming from Better Homes and Gardens next time, I guess I'm going to want to read the article and follow what it says.
Well, that insert Death of Equities is actually from Business Week back in the late 1970s. And that magazine cover at Business Week appeared just in time to launch the longest secular bull market in history. So again, the point being that every once in a while, one of these magazine covers can really be a contrary indicator. So if you see this on the newsstand tomorrow, this is what you want to do. You basically want to scrape together whatever cash you can find and buy excellent companies at a good price, and rinse and repeat. So that's
doing it carefully and methodically, doing it with a lot of thought. We're trying to convince you that you don't just listen to a name or two that somebody gives you on a program like this one and go out and put your money down. It takes some time, takes some study, but you can really do a nice job by buying low and selling high. Isn't that wonderful wisdom, Mark?
Absolutely. All right, let's go ahead and press on. Next topic. This is actually a piece of correspondence talking about being the stock watcher for Car Gurus for a club here in Michigan. And they have a policy that if there's a big enough differential between what the club studies and what the analyst consensus, the manifest investing par is large, you basically should attempt to figure out why. You know, basically, are we looking at different growth assumptions, different profitability assumptions? What can you look at to try to figure it out? And every once in a while, it just gets a bit crazy. And Car Gurus is an example of a fairly small company. It was amongst our best small companies for last year. And he's basically just saying, this has been a bit of a roller coaster. Can you give some insight as to how we might look at a company like Car Gurus? Anything you want to add to that, Ken?
No, except that it was the absolute best time for me to sit in a corner and stare at the wall and repeat up, straight, and parallel, up, straight, and parallel, up, straight, and parallel, and then to remind myself that I also had to look at what the analysts were saying 1, 2, and 3 years down the road. I had to do both of those things together to come up with a really good analysis of car gurus, or anything in the used car market for that matter.
Absolutely. And Ken, you're quite comfortable with that being a camel on the right?
I can see the camel on that one, right, Mark? No problem at all.
Okay. Well, here, let's take a look at the situation that you're basically dealing with. And anytime you're dealing with a small company, you just have to factor in a few things. And the first being limited track record. You know, they have been through probably not even one complete business cycle. The recession of 2020 really isn't that much to really gauge how a company responds to that type of an economic challenge. So, you know, more time is better, and we know that. We try to encourage even a few more years, if at all times, but it can be right to pursue a situation like this. The other thing that's compounding, and we recommend that when you're dealing with a small company, you know, outside the value line standard edition, for example, just be aware that you could be dealing with 1, 2, 3, and in this case 4 or 5 analysts, and they can be quite volatile in how they change their opinions. And when one of them, with such a small sample, when one of them changes their opinion dramatically, it can have really a dramatic effect on the overall look for the company. Anything you'd like to add to that, Ken?
Well, no, except that I think that there are always sources to help you project out into the future, and I know I even get into this and with people in my own club that we become very stubborn with only looking at value line material. We don't make an effort to move beyond value line material, but you got to remind somebody that this is not a full value line sheet. You're not looking at any analysis 3 to 5 years into the future. You're seeing a couple numbers 1 or 2 years into the future. But you're really not seeing anything that's going to help you do a good solid stock selection guide or a good solid analysis. And the trouble is that there's nothing or virtually nothing in that 2022 column except for those little dots on the graph and those price bars on the graph.
Mm-hmm.
And that has to direct your thinking in a way that says maybe the trends that weren't all that trendy to begin with, maybe they're broken now. I mean, operating margins of 19.8% for 2 years, maybe they haven't held up for that third year. Profit margins that go from 14% to nothing, you know, you got to take that into your analysis. And when you do all that, then I think you begin to get much closer to the analysis that Manifest presents on the pages of Manifest Investing for the individual stocks. You can't just assume that they're going to go in the direction that 1 or 2 numbers, you know, 1 number does not anything make, and 2 numbers does not necessarily make any kind of a trend that you can follow.
Yeah, and that's a good segue, because here you're looking at the situation again.
Guys, can I jump in on this point?
Yeah, go ahead, Kevin.
I was going to say, I'll echo again what Ken was saying, is that if you look at this in the small and mid cap edition of Value Line, we have a stock in one of my clubs, Axios, ticker symbol AX, and it's in the small and mid cap for Value Line. In Morningstar, it has a Q rating. In other words, you get the stars up there, but it has the Q next to it. And then with CFRA, it looks like it has a buy rating on it, but it's really more quantitative. So all of them, you have to be careful on whether they have an analyst covering it or not.
Yeah, that's a robotic analyst, I think. Yeah. Okay.
Anyway, that's it.
Yeah, and here's an example of what Ken is talking about, and it's actually, it can be even a little bit more confusing. I'm using Y charts as a source here just to take a look ahead at 22, 23, 24, And you can see that these guys have a pretty optimistic, again, this is the analyst consensus now. And they're looking pretty optimistic. But you heard Ken, good segue, Ken. I mean, they jumped up to nearly 20% operating margins. And you can see here that the analysts going forward, even though they're actually fairly optimistic, pretty aggressive, really, they are projecting a flattening of profitability. And it is interesting that more analysts are coming on board here. You see 14 here, 10 here. But notice that the decline in sales between 2022 and 2023, talking about a decline year over year, calendar year in sales. And then notice also that probably different flavors of earnings. I'm not even sure I could explain, but definitely a number that doesn't look a whole lot like that number there. So you want to become familiar with, as operating versus, or as reported versus operating. But again, that plateau. We'll go to the next page. Well, here's just kind of an interesting tidbit. Anytime that there's been a severe economic disruption in the market, the number of used car salesmen has actually gone down. And you can see it here back during the 2008-2009 situation. You can actually see a slight decrease on the far right-hand side. That's what's shown right here. So definitely a challenged market. And then the next slide. Again, I think there's a lot to like about this company. Longer term, if you dig in and study the literature on the company, what I mean by that is, this is a fairly legitimate trend, longer term trend, including the analyst expectations for these 3 years. And again, quality is low because of the limited information. But one of the things that I do notice is they do have a significant amount of cash on hand, cash in their wallet. They have no debt. You see here, no debt. And they actually have more cash than their total liabilities. So there is some financial strength here over time. And Morningstar really likes the company. So, I mean, there's some things going on here. But keep in mind, that's after the prices come down to 13.
Mark, we studied this industry in 2 of the clubs that I'm involved with, and came to the conclusion that you can't study a pure play used car dealer without looking at what's going on in a regular type of car dealer nationwide or worldwide at the same time. Used cars usually have a certain level of sales, and those sales are coming from people that can't afford new cars. And you look back on everything now in the last 2 years and you say to yourself, well, used cars were impacted by the fact that there weren't basically any new cars for a lot of folks to buy. And if they needed transportation, they had to move to used cars, which just artificially inflated prices, and that artificially inflated margins and everything else. We weren't in a regular time to be studying, and therefore there weren't any trends established during that time that we could rely on to project into the future.
Yeah, and that's a great point. I mean, that inflation, I don't want to say that used car dealers took advantage of people, but this is true in many industries as you look across the board. Even we were talking a bit about Moderna earlier today with the COVID bubble, that huge jump up. You have to be very careful not to be unduly and overly influenced when you're trying to build a representative appreciation of the trends by what happened in 2020 and 2021. And it works both ways, to the high side and to the low side. There is just that disruption we talked about as being part of the chasm. This is basically a upside down chasm staring back at us here. So again, I look at the company, if I'm buying it today or if I'm stuck with it in a portfolio, I actually have a little bit of faith that these guys are working things out fairly well. If they hit these type of numbers for margins, and if this type of growth continues, mid to upper teens for overall sales growth, long-term trend.
Yeah, one of my clubs didn't buy Car Guru Smart. We bought Car Max, and we held it for about maybe 14 months. And it was a reasonable investment during the times when there weren't any, or there was a shortage of new cars to buy. But the more our stock watchers looked at the club, at that stock, the more that they realized that as new cars became something that you could go to a lot and buy again, there was going to be a decrease, and perhaps a significant decrease, in the number of used cars that were sold on these used car only kind of lots. So it's important that all of that information, and maybe when you go down to operating margins or some of the other graphs that you have on the display here, maybe you say to yourself, that one that you're pointing at with an arrow on the operating margin, those 2 years, maybe instead of worrying about them, maybe you call them outliers and you kind of ignore them, and you try to come up with your trend from 2017 through 2024 without dealing with those two outliers that are sitting in the middle of the graph.
Yeah, if you average those last 5 years, you get a different number than this number, which the 10% that you see there, you can rationalize that based on what Ken was just talking about.
Yep.
Yeah. All right.
And that might be much closer to what's usual in a market where there are new cars and used cars for sale.
And we'll come back to this subject in the future and talk about the impact of electric vehicles too. All right. Just kidding. Well, not kidding, but kidding. Anyhow. All right, here's the groundhog standings. No real major changes. We continue to have a lot of the celebrities up towards the top. Eddie will be coming out with his list of new stocks for 2023. I believe next week. It's within the next few days. Herb continues to hold down the number one position for individuals, and Kevin's Montgomery County club is still the number one group entry, followed closely by defending co-champion Space Coast Florida club, and Ken was a bit thrilled to see number 40 there. Another former champion. Any thoughts, Ken?
That damn monkey is still up there at 12. So.
Uh-oh. He said D-A-M-N.
D-A-M-N, yeah.
I'm amazed at the italicized entries up at the top. Still way fewer than we're used to seeing at the top of this board. I did move up again. All right, quick snippet, quick moment. You weren't happy with my criticism of the New York Times last week, so here's another fun fact for you. This guy's a honcho at Morningstar. Just another data point, and again, not measuring it the same, but just to give you some feel for longer-term performance. He's looking at 5-year spans for a whole bunch of case studies and pointing out that, again, the more typical number is in that 30 to 40% range for long-term performance. There are active managers that do pretty well. They are more rare than they should be, but we believe that they can be found and or followed. We do like borrowing ideas from those that demonstrate success. You okay with this one, Ken?
Well, very okay. And wouldn't the folks from Vanguard say, and isn't it sad that not even half of the actively managed funds beat just a plain old index, and they would leave it at that for you to think about then?
Yeah, I mean, if you think about it in terms of our performance accuracy that we talk about at the roundtable, and we're shooting for 50 to 60%, I think this helps you understand that that's actually pretty special, the fact that we're in that 51, 52% range, because this number's under 40 for the whole universe. Interesting stuff. Okay.
Mark, the next time Groundhog comes up, Len wants to develop a new model club, a nationwide model club, and he says, could you help organize it? Anybody that wants to be a member will take a dart and throw it at a list of stocks, and we'll put those on the list, and we'll call it the Monkey Model Club, okay?
Okay. All right, let's go ahead and round out. We've got a couple minutes left. Just thought we would toss a few more names out there. As you know, last week we put Amazon, Malibu, Tesla, and Generac on the list of our dozen stocks for 2022. Basically going to compete side by side versus the Barron's selections and hope that we do okay. I kept Car Gurus just for a placeholder. I just want to keep track of how well this company does from now until a year from now, Ken. So I kept them on the list, and then I actually put Morningstar in here just because it's been so good to me over the years. Wendy's got this as a major position in her IRA, and here's basically what it looks like. One of the other reasons I chose it is they are related to the dairy business between them and Oberweis. That must be a northeastern Illinois thing. But the eight maids of milking or 7? I don't remember. Must be 7.
It's 7 swans of swimming. I know that.
8 maids of milking. Anyhow, I just love the expression on the cow's face there. Over the long term, I mean that sales line is pretty impressive. These guys do good work. We track several of their key analysts. And that blue line is always above 1, always positive. They have had a fairly good downdraft in stock price of late, so they are trading at a multi-year high. It's not sexy, but it's just kind of a base load company. Plus, I just love the dairy connection and, of course, the Morningstar reference. All right, so with that, one of the things I wanted to point out, Ken, as we shop out to round out a few more selections, interesting list. I look for companies that are trading for less than 30 on the relative strength index, and I found all these regional banks. So I figured you might be tempted to add a regional bank. Am I reading your mind correctly?
Not only am I tempted, but I know which one I want to add. My mind moves immediately to Western Alliance. I love First Foundation, FFIN as well, but comparing all the numbers that you're displaying right there, I think Western Alliance more than says top of the heap at the moment. So I'd like to do Western Alliance and put it in the list and give it a try, see how it works.
Yeah, Western Alliance, many of you already know, this was our top performing stock for our best small companies 2 years ago. And it's bolstered a number of portfolios, and that return on assets pretty strong and consistent. So that's a good one. I'm going to go ahead and suggest that we put another one of our small companies on the Christmas tracking list, that being Yeti, Ken. I like a lot about this company.
And I'm in a club that would agree with you. We're so happy that we bought Yeti a while ago, and just watching it do things completely opposite than the market's been doing, especially recently. So yeah, I can agree with putting Yeti on there and taking a good solid look at it. Yeah. I also like, Mark, I really like the way that our stock watchers are talking about Gentex. Gentex is a high-tech auto supplier. I don't know if it's a tech company or an auto supply company, but no matter how you want to think about it, it's been depressed right now by the chip shortage, by the way that parts are moving through the supply chain and everything else. But as car manufacturers get back to manufacturing cars, Gentex, who provides product to almost every car manufacturer in the world, Gentex is going to, in my opinion at least, thrive. I like that one as a possibility for the list as well.
Yeah, and one of the things that we have tried to do is we do pay it's our theory, and one of these days I'm going to come up with a way to measure this in a little bit more detail. This is the analyst consensus 1-year estimates, and we are trying to stick to the ones that have a little more tailwind to them, in combination with, again, when you look down this column on sales for 23 versus 22, you see some negative numbers here, and we're trying to stick to the ones that are more positive. And that I hope that'll keep us out of trouble in the best small companies. It's served us well so far, but we'll probably round out with a couple more of these companies. I'm going to take a good hard look at FedEx. They actually report her earnings later today, but after spending some time in line at UPS mailing Christmas packages yesterday, my field research is that there has to be money being made there somewhere by somebody. I had one package they wanted to charge me over $100 for, and I had to figure out how to do that a slightly different way. But they do a report, and we'll probably be talking more about what implications Amazon, UPS, FedEx, all of the above suggest.
Mark, do you know anything about Livent with the ticker LTHM? I'm wondering if it has something to do with lithium.
It's definitely a lithium company.
Okay, and I really, of the sales, the forward sales number, it's by far the stellar number on the list. I just don't know anything about the company itself.
Yeah, they're predominantly a lithium producer, and they shot up with all the interest in lithium a couple years up back, and they have settled back into a potentially more attractive range, and you can see that the relative strength index is down here, so that could be worth running up the flagpole. I think a good study for anybody out there, either individuals or clubs, you might compare Livent to MP Materials, and just study what the two companies are doing, what they produce, and what the implications are. Where's the opportunity there?
The 97% price to fair value from Morningstar is a cautionary number for me, but I just don't know anything about that particular company. And usually on a list like this, I'm familiar with almost everything on the list. So
pretty sure they're a direct competitor with Albemarle. I think I got that mostly right, pronunciation. So good study. All right. And then we're coming up on an hour. We're actually at an hour. Ken, you want to describe this finding?
I got an advertisement in my email, and I get hundreds of advertisements in my email, but this one came from Morningstar, unsolicited. So I opened it up and took a look at it, and lo and behold, they were showing me their exponential technologies list. Basically, they were saying that in their opinion, this was a list of companies that they felt were some of the most innovative in the world. And this was a list of companies that they felt had the opportunity to really change the world with the kinds of things that they were doing in the short term and in the longer term. I happen to own 3 or 4 stocks on the list, so I took a good hard look at it. And if you're looking for ideas, I think this is a pretty decent set of ideas to do a couple deep dives on. There's some new technologies, some old technologies, some pharmaceutical stocks in here. And there's a couple that will be surprising because I think they're names that, for the most part, the community that we're in doesn't talk about them as much as maybe you should. There's also one that I'm particularly negative about, and I'll just mention that I just crossed BlackRock off the list from my point of view. I just feel that I don't understand what it's trying to do. BlackRock is some of the largest hedge funds that exist, and I'm not quite certain what a hedge fund is. Mark, can you tell me what a hedge fund is in 17 words or less?
Oh yeah, Berkshire Hathaway. The original hedge fund. Well, BlackRock isn't just hedge funds; it's all kinds of funds.
Oh, it's
Traditional
all
mutual
kinds of
funds,
things. Absolutely, yeah.
including the tax savings plan for government employees. But
Yeah.
yeah, it's a capital behemoth with a capital G to launch that word. So yeah, I have some heartburn over some of the implications of that. But
Yeah.
from top to bottom, my reaction to this list was, this is Hugh McManus's vetted list. And I'm not kidding, folks. I mean, I know for a fact he owns, if it says healthcare on here, he owns it. And you know from his appearances at the round table that he's talked about Lilly, Gilead, Johnson & Johnson, and Merck over the years. So I think what we'll do, I'm going to put together a Morningstar feature. It'll be on the homepage within the next day or so, and we'll include a current analysis for all of these companies. And then there's a couple other features that Morningstar's come out with here in the last couple of days. I just think it'll be a nice smorgasbord. I want to take a closer look at Guidewire Software, Ken. I don't know much about that company.
Right. When I sent you the list and when we talked about it, that was the only company on the list that I could not give you a thumbnail on. So let's absolutely let's dig into it and see what it does.
Okay. All right, some good studies there. Here's your reminder that we do archive all of these sessions, roundtables, and bull sessions at YouTube. Just simply go to YouTube, search on Manifest Investing. We'd appreciate it if you would subscribe, and we'll let you know anytime new content is added. I know some of you are reluctant to do that, but we'd sure love to let you know when we put new stuff up there. Just click on the subscribe button. And in the spirit of the season, with Epiphany approaching, that comes after Festivus and Christmas, Ken. Epiphany's out there too. And those
Epiphany
are not
is Russian Christmas, Mark.
Those are all camels, Ken. There's no turtles that I can see on this.
I got it. I can see them. I can see them clearly. Okay.
All right. And with that, we'll just simply note that there's the performance of our smaller companies. And we're not going to talk about it other than there's that company that, if you're not familiar with MP Materials, a good study of that versus the lithium company might be a decent idea.
I think we can make the 1 point mark that, as in past years, all of the return from our top performer can cover all the losses from the bottom 6 stocks.
Mm-hmm. We hope to see that repeat itself again.
Absolutely.
All right. So with that, the one thing I would like you guys all to consider, I'll put up something on the website. Again, if there is a moment in the last year, and as an example I would give, I had a moment with Body Central several years ago when I bought a company that had no debt and it proceeded to go bankrupt. Ken remembers it well. We talk about lessons learned, but that was a type of moment for me from a few years ago. If there's been any moment that you enjoyed or it was a major takeaway here at the round table, please consider sending a note and highlighting it. We'd like to include it in next week's program. So I will put up an invitation, kind of an invitation for papers or moments on Manifest, and look forward to seeing what's on your minds.
Mark, we did get a request to add Middleby to our list of stocks to do a little bit of a dive into, and Middleby's one of our we've favored it at various times in the community. So if you could add that to the list of stocks we're looking at, Dean would be very appreciative.
We will definitely do that. Out of Elgin, Illinois, which is almost where it's a little bit northwest of where Kevin Gillogly's headed as we speak. All right. So with that, this is the last time we will be together before Christmas. So Merry Christmas, Ken.
Merry Christmas to you, Mark, and to your wife and your grandkids and everybody else. I hope you have a nice, quiet, happy holiday, and the same to the listeners in our audience. Thanks for listening to us jabber on every Tuesday, folks. We appreciate you coming, and we hope we'll be able to talk to you next Tuesday again.
All right. Merry Christmas, everybody. Find those Santa Claus rally opportunities.
Bye-bye.
Bye-bye. Take care.